right, we'll go ahead and get started, and
We have rental management.
there'll be a few stragglers popping in, so.
Rental management company.
Don't get hit the button.
Who?
Camera. Brian's.
It's on, he already put it
You
on.
turned it on?
Yeah, so
Oh,
it's
okay.
running now.
Okay.
So thank you. So this is really kind of an informal roundtable, kind of a couple of topics I've heard from the 4 offices as I visit them that don't seem to be as clear. You know, a lot of us have many years of experience, and the big thing is, there's 2 big things that I've come up with in the last couple of years. A, you got to be ready to change, and the way we used to do it isn't the way we're doing it now. And so every day it's new. And this page here is just to give you an idea of where I need to go about 25 times a day when somebody asks me a question. And I used to could just answer it. I'd just say, this is it. And now I'm afraid to, because it could have changed since yesterday. So if it's really a critical question, I usually, if I don't answer, I usually say, I'll get right back to you, and I go in here and check type thing. So we had yesterday's sales meeting here. Dodd-Frank came up a couple times, and I'm sure you all have heard Dodd-Frank a few times. And I had even asked in our sales meeting if anybody knew what Dodd-Frank actually stood for, and nobody would know because it's ridiculous. It actually stands for Dodd-Frank Wall Street Reform and Consumer Protection Act. So they went after everybody, Wall Street, lenders, banks, everybody in particular. And so they put panels together, and they've been coming up with more and more rules that they believe are helping the clients, the customers, protecting their rights. And what they're doing is they're making it more difficult for the first-time home buyers and those that really need the help, maybe self-employed individuals, people like that, that really need more opportunities. They're falling short. So they're still there. Lending is really back to 1998. Okay, so for those of you that were in business in 1998, you had to full qualify, you had to produce your income, you had to produce your assets, and you had to have a job. It hasn't changed. It's just gone back. So it is full doc. There's very few, well, they use the word guideline. It's really not a guideline anymore. Guideline used to be a little above, a little below. So some of the topics that I thought we might talk on, because I'd shown interest, was a little about the HUD 100 and HUD programs. A little bit about what are the issues that have a tendency to pop up on FHA. A couple of the challenges on VA and conventional. What's a conventional loan versus jumbo in that? And foreclosures, why have they slowed? You know, why is they're not having as many units coming out as everybody thought? Why did the bank stop foreclosing? So, and then anything you want to ask, or this is totally your opportunity to, if you got a question and something's on your mind, just jump on that. So I only got a few questions. So one of them was from Mr. Portugal. He wanted to know about the HUD loan program. And so why don't you ask your question that you were wanting to know from me, so we can get everybody on, so making sure I'm answering the right question.
Okay, well, yesterday I was at the IVAR, or not yesterday, the day before. IVAR had a meeting on HUD, and they do every month. And they just give you updates, because the HUD's always changing, just like Brad was saying. Your loan programs are always changing. So from one month to the next, it could be something different. So anyways, the one thing they did stress yesterday is when you do get a, make a HUD offer and it does get accepted, to make sure that your loan officer knows what they're doing as far as the HUD loan process. So I asked Brad today, Brad, what is the difference? And Brad, go ahead and take it from there.
Okay, so HUD has several programs. There's 2 programs that maybe you've heard of: FHA Good Neighbor Next Door, GNND, and the 100 Down program. And there's a specific thing for that. And then of course you hear their numbers. There's 203B, 203K, there's a 203H, and there's a 203B repair escrow. There's a 203K streamline versus a full 203K. So almost every product that I've ever heard is a 203 something. That's FHA's codes. So on the HUD loans, quite often the 203B repair escrow pops up. And what that is, and it's not just on HUD homes, it's any FHA. You can do this on any FHA transaction. Just most people have forgotten about it over the years. It means that you can take up to $5,000 and the customer can put that money in to escrow. Okay, it's not part of the earnest money deposit, it's not part of the down payment. It is set aside for repairs after the fact. All right, so the rule is they can put that $5,000 in there. After the transaction closed, they have 60 days in which to complete that work and send the certification of completion to HUD, okay, or to escrow, or whoever's monitoring. So it's been around for years and years and years. So on a HUD loan, a HUD REO, anybody not know what that is? On a HUD REO, they don't have to do an appraisal. So there's no appraisal required on a HUD. And so since there's no appraisal, the little tricks of health and safety doesn't pop up as often, because that's usually something triggered by either the appraiser, or if you were to order a termite in advance and turn it in with the package and it gets on the HUD, underwriter can't ignore it. Then they're going to want to see it. In Section 1, you can't get away from it. Section 2, you can negotiate, but not Section 1. So that's the program for what they call the repair escrow, and it's available on any FHA loan. And that way it gives somebody an opportunity to buy that property, maybe gives them a little advantage because they know there's got to be some repairs done. And it's similar to the Fannie Mae Home Path. Anybody ever done one of those? Yes. Yeah. So again, no appraisal required, and they only require you can actually do a Fannie Mae Home Path with 3% down. So, but people didn't know that. So that's a little bit about that 203K or the 203B repair escrow. The regular 203B is your normal FHA loan you do every day. 203H, or is it C? C is a condominium. Separate program for condominium because there's different criteria that the project has to be approved. It doesn't matter anymore if the project was approved 2 years ago. It may not be approved today, and it may not get reapproved. So that's just one of those things we have to check on an ongoing basis. So if you get into doing much condo business, you might want to come and sit down with me for about 20 minutes, and I can give you some of the watch out fors, you know. And if somebody really wants to get into it, we can do that now. But condos, VA don't like them. They're almost impossible to get a condo through a VA loan right now. 75% owner occupancy required on a project for a VA transaction. I don't know too many projects that have that kind of owner occupancy. And so what they look for is off-site. How many off-sites are there? I mean, that's the terminology that will come out in your HOA certification that you get from the board. So 203K Streamline, anybody ever heard of that one? It's the home repairs that you can do. It's up to $30,000, $35,000, and it cannot go $35,001. Okay, closing costs, fees, etc. So you have a house that is listed and it says not FHA eligible. Well, that may not be true. The reason it says not eligible is because it's got health, safety, and other repairs that the seller is not willing to pay. I'm not paying for that. Pay cash. Fix it yourself. 203K lets us do the repairs after the loan closes, up to $35,000 including cost. And what would happen on that, we initiate as a 203K on your contract. So in your loan financing, you would want to make sure you spell out 203K Streamline. And the reason being is
I'm sorry, I may have missed something here, but you're saying 203K Streamline.
Yeah, there's two levels of 203K. There's the one we're talking about right now, which is a 203 Streamline up to $35,000. And they also offer a full bore 203K, which is when you have foundation problems, structural problems, and they might almost knock the house down. And they offer that as well.
So it has to be something that severe to be just a straight 203K?
Yes. You wouldn't want to, because it requires too many other inspections and certifications. You have to have engineering certs. It gets really, really complicated. And I can honestly tell you, if you are doing with a loan officer that's never done a full 203K, you're just asking for headaches because it's very complicated. But on the Streamline, this thing lets me power up. On the Streamline, what it does for us is, so you put an offer in. all right? And so let's say the customer wants $150,000 for it, and you know, pretty sure it's gonna need $25,000 in work. And you don't really want to pony up 25 more thousand, or you don't have 25,000 more. So you can do a offer of $150,000 with a $25,000 acquisition price through 203K Streamline. Now you, as an agent, are still paid on the purchase price.
So your loan is now 175.
Your purchase price is still $150. That is your price. The acquisition price is the price that the consumer is now getting the loan for, and which means they're looking for $25,000 in repairs to be done within 6 months. And it's a time, 6 months after closing. Okay? But they must also occupy the property within 60 days after closing. That's a 203K. So what happens is now when the appraisal is ordered, the appraisal is ordered with a 203K specialist appraiser who's certified, and we have to also submit bids. This is what's going to be done. Here's the work. And he appraises the property for what it's going to be worth after it's done. There is a 10% additional allowance on top of that allowed on a 203K. So you almost never come in short. It also gives you an extra 10% that you don't get on a regular FHA loan. So if for some reason a couple of repairs you totally missed, totally forgot, because not all repairs add value, right? I mean, the roof's bad. Okay, well, you kind of expect it when you buy a house, you get a roof. You know? So it doesn't give you extra value, you're just getting a new roof with a 15 or 20 or 30 year lifespan. So it's appraised for what it's going to be done, doesn't affect you, it still closes like normal, your commission's paid like normal, my commission, if there's any, would be paid like normal. The difference is now, once it's closed, it goes to a escrow division that controls the funds paid to the contractor who was approved. Much more depth, there's a lot more going on to it, but that gives you enough to know what it is if you ever need that program. Full 203K, probably aren't going to see for a couple years because you're never going to, unless it's a short sale on REO, it's going to be a HUD home or something. Nobody's going to buy that house right now. I mean, you just can't. It's hard. If it needs a full reno, you know, if the house is worth $100,000 as it is, it needs another $100,000 to bring it up. But it can happen. So that program's there. That's the 203s. So this here, I have the handout for it here, is about the Good Neighbor program and the 100 down, and it just kind of gives you a couple ideas. So a lot of things that people don't realize is that if you get a firefighter, you know, it shows you right here, teachers, law enforcement officers, pre-kindergarten, 12th grade, emergency medical technicians, to purchase a HUD REO, and it's in one of these revitalization areas. And what is a revitalization? Well, let's just click and see. They get it at a 50% discount. So if that house is on the market for $250,000, they will sell it to one of them if it's in one of these areas. And this is your HUD website. If you haven't been here, I'm surprised. Then they get it for 50% of that. And HUD eats the difference. Any idea why they're doing that?
I'm trying to bring the neighborhood back.
They're trying to bring the neighborhood back. So they're bringing back law enforcement, medical, teachers, you know, to get them. So maybe a teacher or a law enforcement officer to save $125,000 might be. Can anybody think of an area right now that this would probably help a lot? I have a city that pops into my head.
San Bernardino?
Yeah, a little further up the hill. But yeah, that would be one probably. But Adelanto and Phelan pops into head for me. They need help.
No, they don't.
You don't think so? Well, the prices would indicate they do, and the amount of foreclosures per person's registered, which is close to 35% of the city is in foreclosure or behind. That's pretty heavy. And my niece just moved there, and they bought a house on a VA home that sold for $407 in 2006, and they just bought it for $141. So there are areas like this, but it will tell you where, and it talks about these things. So this is a good program. It's called the FHA Revitalization Area Sales Program. It's on the HUD website. Again, I won't spend a lot of time there, but I'd like to give you a little bit of visual. The other thing is you can look on here is Good Neighbor Next Door Program, eligible participants, and it shows you a little more detail. Again, it'll be a HUD-based program on their website, but it just eventually it's just showing you that HUD has more programs out there than just FHA, and a lot of people think about just FHA. And we could go on and on. There's a handout here if anybody wants them, and we can talk in more detail on that. So, any questions on FHA that's been on the back of your mind? Other than I'm going to cover a couple things like non-borrowing spouse. And sometimes there's some confusion on what's allowed on what a non-borrowing spouse transaction actually means. Anybody think they know? Want to shoot? So in California, you cannot mandate that your spouse supply with you because we are a community property state. And there are other states out there, I don't know which ones they are because I'm not licensed there, and I have enough in this little old brain, I don't need any more states in there. So the bottom line is, but FHA, unlike conventional lets you apply in your own name, and I don't care about the spouse, you can put her on deed, whatever. FHA won't do that. They will require that you run the other person's credit as a non-borrowing spouse or non-applying spouse. They don't care what their credit score is, but any debt that is open, that is not a joint account showing up under the borrower, is going to be added into the ratios. They're also looking for 5 other things. The most important may be the most obvious. Is there any delinquency or default on a federal loan or debt? What pops into your head when we talk about a federal loan or debt?
Our repo.
Yeah.
Taxes.
Yeah. What else? The big one, the one that has the most. Student loans.
Student loans.
Student loans. They cause me more headaches than you'll ever know, and there's 2 completely different rules for FHA. Actually, there's 3 different rules. VA has a set of rules, FHA has a set of rules, and conventional has a set of rules. Would you like to know what they are, real quick? No? Yes? No. Okay, so on a conventional loan, regardless of if it's deferred or not, you must count it unless even if it's deferred for 3 years. Only, it used to be if it was deferred more than 3 years, you have to count it on a conventional loan. And if it doesn't show a payment, then you either got to get a payment or they're going to apply 5%. Period. It was 3 and they just recently changed it to 5. FHA loans, if it's deferred for more than 1 year, then they won't count it. And VA loans don't care because you're probably under the VA loan program. They don't really care. If it's deferred, it's deferred. So it's kind of an interesting thought. So that's one of the things we have to run the credit, we have to check it, and they can be on title, but they are going to check it. Now if you find that, the other thing they're going to look at is they're going to look and see if there's any CAVers, which is defaults on other federal debts, bankruptcies that could affect something. Was there an FHA foreclosure years ago under another name? They're going to look at the criteria of their address, does it match, type of thing. So those are the things they're going to look for, but mostly it's the credit and bringing over any debt, because obviously if you're married to that person, that debt's in that household. All right. So that's the main reason why. And VA conventional just got tougher because they just, their rates are usually a little better, and they don't get all the mortgage insurance, and it just comes back to start biting them. And you got to remember that Fannie Mae, Freddie Mac are not in control of Fannie Mae, Freddie Mac anymore. HUD is. So a lot of the things you see on HUD happen to Fannie Freddie. So, and in condos, we already kind of briefly talked about condos. You got to remember the fact that condos have to be approved. They have to go through the process. And the areas that I've actually had 3 agents in our 4 branches call me this week saying, "Can you help me? Because I have a condo going and it didn't pass or it got declined." And condo certs is where it's killing us. And so there's 3 key points that you have to address if it's a condominium, especially if it's FHA. Anybody know there? The three main ones?
Tenant versus renters?
Yep.
I mean, owners versus renters?
Absolutely, must be 51% owner occupied for FHA and VA, for FHA and conventional. FHA, VA is how much? Does it matter? 75% owner occupancy. That's one, very good. What else?
The stability of the HOA.
In reference to what?
Whether they
There's two
have,
parts to that.
whether they have reserves, enough reserves.
That's a great answer, but that's not one of the two things.
Okay.
So, go ahead, Matt, what do you think?
Check to see if they're in litigation with anybody.
There you go. Are they in pending litigation? Huge, huge, huge. Well, nobody will step in if they're in litigation. And what do you think, and the last one? This is the one that causes the most grief, by the way, this last one. You cannot have more than 15% delinquency on HOA dues. And I have them all the time at 17, 18, and 19%. Just above it. Now, if your unit is causing it to be just over 15, and if we take that out and they're under 15, then that's a solvable transaction. What I just had a call yesterday, this is a true story, another agent, they went in, they found out they were 19%, there's only 12 units, so the buyer, who's buying it as an investment, decided he would go in and cure the least delinquent HOA, which was like $2,200, so that the 19% would drop to 14. And he did, and they resubmitted the loan back to this other lender, and the underwriter says, you didn't fix anything, you just put a Band-Aid on it, it still turned out.
Oh, wow.
Now, you should, if you're going to do something like that, don't tell me. I don't want to know. And basically, all I do is I send in a cert. We send in the cert. If the cert says they're not delinquent over 15%, I don't care. I don't go back and research. It's none of my business. As long as it's current when I send them the cert. But once the cert, you can't proverbially put it back. Once you pull it out, it's there. So we're trying to save it, and the customer's really upset because he spent $2,300 or $2,700, and not our fault. I mean, he wants me to save it. And then the customer wants me to match a rate that he got in February from a lender that turned him down.
Why did he think that was gonna fix it? Did somebody tell him that would?
I don't know. I mean, had he, first of all, as a listing agent or buyer's agent, and you're doing a condominium, and you haven't done a condo search, spent the $75, you're just playing matches. But you're gonna do a lot of work for stuff you won't know until, usually the lender requires the cert. I highly recommend it. It won't show up on a prelim or your property profile. And most HOAs will not release that without, then that'll, and it's usually like $75, $125. So as a listing agent, I definitely would want to know. Because now that's going to tell you, is it financeable or not? So those are your big three on condo projects, okay? And we run into them constantly. So we talked about HUD a little bit, we talked about Dodd-Frank, we talked about a little bit about VA. So one of the things that came up in our sales meeting yesterday, and then we'll open up a little more for a couple other things. So we were talking about why have foreclosures seem to dry up, but yet there's tons of people behind. And we didn't have time yesterday for me to answer that. So does anybody have a theory why foreclosures stop? Yeah, Mike.
The banks are being more careful because of that whole robo-signing thing, so they're taking longer, they're going through the paperwork 2 or 3 times, where in the old days, they just shot everything through like a cannon.
You're right on it. That's the majority of it is robo-signing hit us. And so what just happened in this week, yeah, it was called robo-signing. They were hiring outside agencies to sign the foreclosure paperwork. And the feds came back in and said you didn't legally notify these people that you're foreclosing, you didn't do it the right way. It's one, you know, one document you screwed up, and so now you don't own the home, they still own the home. But they foreclosed on it, sold it to somebody else. Tough, pay them back, give them their money back, give them another house, I don't care. Give that house back to these people. So everybody see they're mailing checks out this weekend for $300 to $600 for the first 1.4 million people that they feel got nailed on that. So here's what happens with a lender. Anybody here frustrated with their lender, a lender, any lender, or with the current financing process? Anybody frustrated with it? A little bit. I'm frustrated in it. I'm in it every day. You gotta understand, the rules are gone. Common sense is gone. All right? So, true story. PHH, the mother corporate of me, that watches over Coldwell Bank and Mortgage, had to buy back a loan for FHA that was 4 or 5 years old. 4 or 5 years old. It had never been behind. It had never had a payment missed. Okay? And the client died. That's in our control. Customer died. And upon reviewing the documentation, they found that it was a document, like a pay stub or something, that was not within the time frame that it should have been when the loan was made. It wasn't within the most recent 30 days or whatever it was. And to make it even worse, they didn't even need that income to qualify. But the document didn't meet guidelines, and it was HUD's out to make them buy it back. Rather than, gosh forbid, hit their FHA pool. Now, that's pretty spooky as a lender. You know, I mean, we didn't do anything wrong. We gave you a compensating document to show you made other income, but we didn't even use the income. Didn't even affect the ratios, and it still made them buy it back. So it takes longer, way more manual underwriting. The smaller the company, that's why brokers. The only issue I have with brokers, I was a broker for many, many years. I made a great living at being a broker, but brokers are not lenders, and that's the part you got to remember. They're generally writing that for 1, 2, or 3 different agencies that they're going to be potentially delivering that loan to. So you have that disconnect. You just don't know what that, you know, that agency, they're not keeping up every day with what that agency's doing. Where every day I'm notified, email, updates, this, that. So that's kind of your protection factor. So that's a great hit right on there. That and the fact that now, why foreclose? Values are increasing. Just leave the people, because if you take it back, now you got to fix it as a foreclosure before you sell it. No, I'll just leave them in there. I'd rather have it occupied than unoccupied for 5 months, because I got 400,000 more units I'm worried about. I can't worry about that one yet. So they'd rather leave them in there for free, at least somebody's watching it. The second it's vacant, what happens? They steal the copper, they steal the air conditioning, the CPU, you know, all that stuff is gone. I actually had 2 years ago, and this is a true story. So I had a fourplex that this customer was buying, and we went out there, and 2 of the units were missing, the air conditioning units and certain things. So we went out, and they fixed it. I got a notification it was done. I ordered the re-inspection. The next morning, the inspector was out, and the units were gone. We did that 3 times. We finally got the lender, the REO owner, to hire a guard to stand there overnight so we could get the inspector out the next day to see it was there and sign off of it, which we did. And so we closed. Guess what? They stole it the next night. We didn't care. We got the inspection done. It was there. So it's just amazing. So yeah, the banks are, you know, and don't get me wrong, the banks, Wall Street, everybody caused the debacle. you know, the picket payment arms and the stated income, you know, when I was with Wells Fargo, I was doing modification reviews and was their partner with HUD. And so I had this lady drive up from Carlsbad or Oceanside or Escondido, somewhere down in that area. And so she owed on a home in that area $560,000 on a home down there. And her payments were $3,800 a month. And so she brought her income documentation. She was a self-employed, what's the word? Housekeeper? Where she would go in and she was making about $31,000 a year. And they sold her that house. 100% financing, 80% first, 20% second, no money down, 1% picket payment arm. So she went to loan mod. Okay. Ma'am, if I gave you the loan for free, if I charged you 0 interest, and dropped the balance $100,000, you can't afford to pay it. But it's my home. We only had it 2 years. But it was her home. And there was nothing we could do. And then I was the rotten, you know what, that wouldn't give her a loan mod. So that's another thing. B of A and a couple of the big banks, another reason that foreclosures haven't happened, to try to make sure they have complied with making home affordable. They actually attempt modifying them 2 or 3 times. And each mod attempt can take 3 to 6 months. So that was a reason for a while why you weren't getting your short sales approved as quickly. Remember that period of time where getting a short sale approved from B of A and a couple of them was taking 11, 14, 16, 18 months? And you're going, why? Why does it take so long? Because if they didn't do their due diligence on doing a loan mod, they could come back and bite them, like it did on the foreclosures, and the person would own the home free and clear. So now, this is starting to lax a little bit, but it's going to get a little stricter again come first year, because you have a new agency formed called the Federal Housing Finance Agency that goes into effect under Dodd-Frank January 2nd, 2014. And we don't know what the rules are going to be yet, but they're coming. So that covers that a little bit. Does everybody understand loan limits? You ever heard the term conforming loan limit? Conforming loan limits is the same everywhere. Currently, for a conforming loan, for Fannie Freddie, it's $417,000. It's been there for about 3 or 4 years. In 2009 through 2011, there was a expanded program called High Balance. It's not a jumbo, it's a high balance. And so San Bernardino, Riverside County was given $500,000 as their high balance. And LA County, and that for a while was $726,250. Orange County was like $626,500. Currently, there is high balance not in San Bernardino, Riverside County. We're at 417. At 418, you're on a jumbo loan. But Orange County and LA County and San Diego County do have a high balance of 626. And I forget the exact change. And I don't do a lot of them, so I don't know the month. But I just did open an escrow in Santa Ana. Purchase price was $555, 5% down, which is a pretty good chunk. And the rate on a 30-year fix was 3.375 on a high balance. So that was cheaper than the conventional loan at 5% down. It was cheaper. Yeah, I brought it up a little bit, but it was still cheaper on the rate. So, so the conforming can change by city, and it will change again December 31st, 2013. One of the things, I was in your training class the last 3 weeks on the contract. And one of the things that I noted was that when these contracts are being written, the section on finance terms, Section E, the balance of purchase price or down payment, was being misunderstood. That they were putting numbers in there that they probably shouldn't have dealt with. You know, put down your 3%. Lance recommends it. We recommend it. Don't expose your customer to any more than that, because remember on the last page, 3% is all they're required. You know, that's the only thing that's going to be in litigation. If you put 12% down thinking your offer is going to get accepted, and now it falls out, that money's tied up until both parties sign it. They don't sign it. I think Lance said it was 3 years. It's and then if it's still not settled, and it goes to the state. The state loves you to do that. They need the money really bad. So I wouldn't do more than 3. You know, I don't think there's very many properties that percentage is the difference. You know, if it's on that type of property. I mean, not in the number we see. And, you know, I'm not gonna say I personally see them, but corporate tells me, you know, what the normal is, and they're saying thousands of transactions a month nationwide, so, type of thing. So, you know, that's an area that I would just do the 3. Just pick your program. You know, if you're not sure, if you've got a listing, please, whether it's me or you have another lender that you love, please get cross-qualified. And make sure it's from somebody you really trust and know they know what they're doing and are staying up on times. I know that sometimes you get a Fannie Mae property, or if it's a Wells Fargo REO and they say they got to get a pre-approval with Wells Fargo. That's true, they do. But it doesn't mean you can't get cross-qual with your lender. And if nothing else, if it falls out, then you can just move it over to whoever. If it's me, then we should be prepared to just take over for it. You see what I'm saying? It's quicker. I also have to talk to the client. Now here's an area that I'm starting to get some pushback. There's another Dodd-Frank created it, but it's part of the privacy and red flag and red alert thing. So when I'm cross-qualifying a customer or I'm talking to a customer, it is not legal for me to gather the information from you, the agent, or the other agent, or the other loan company. The new rules say I will contact the client, talk to the client, and get documentations directly from them. And the reason is they found altered documents. And realistically, you want me to talk to that client because I ask questions, and you amazed when you get a customer that wants something. What's the first thing they start doing? They start talking. And you will be amazed at things that you learn, and you don't even have to ask the questions. And all of a sudden, I hear stuff, and I'm going, "Oh my goodness, we took that off the listings." Yeah, I'm not really living in the house. I bought it from I'm buying it from my aunt. I've heard that numerous times. Oh yeah, I'm not getting transferred. They said we were transferring from Nevada. Nah, I'm not transferring. It's an FHA loan. Is that a problem?
I like that.
So, and then you've taken it off. I had one just recently with an agent here. Agent here. It was a VA transaction. And I convinced the agent to give me, and this loan's been going for 2 weeks. You know, he's ready to accept this offer and take her listing on him. So she, at the last minute, gave me a shot. All right. So I called the guy up. It was a VA transaction. I said, okay, just curious, do you have your DD-214? And do you have your certificate of eligibility? The 2 most important documents for a veteran. Okay. He goes, well, I do have the DD-214, but no one's ever mentioned that you needed a certificate of eligibility. But now I understand you had a pre-approval from another lender. What does the certificate of eligibility tell us? There's 3 things on that document if you don't know. A, it tells us if he can have a VA loan. If you get a certificate of eligibility, it should be no later than 90 days old, and it should show his guarantee amount of $36,000. If you see $36,000, he can get 100%. There's another line on there that says whether or not the funding fee is waived. Does anybody know why a funding fee would be waived? Does anybody know what a funding fee is?
Your paycheck?
So unlike FHA that charges mortgage insurance upfront and monthly, they charge an upfront funding fee of 2.15% of the loan price. That's their insurance. They call it a funding fee. If you are a disabled vet from being in the service, wounded in action, whatever, whatever, if you got that, they waive that 2.15%. So that could be anywhere from $3,000 to $8,000 in fees they're waiving. So that's a big document. But for a lender to issue a pre-approval letter, for you to go show him houses and not see the certificate of eligibility, in my opinion, is extremely irresponsible. And I'll give you another case in point. Just last year, I was talking to her. She goes, yeah, I've been showing properties for 2 months. We've looked at 70 properties. And I said, cool. And she goes, so our pre-approval's over. We need to get a new one. Would you give them a try? I did. I'm going VA. So I got a hold of the VA. At that time, I just went on the VA portal, and I have authorization, VA certified. And I pulled up and requested it. 24 hours I got it. It's not eligible. Prior foreclosure. So 75 properties later, for this buyer that she's spent hundreds of hours of gas and time, they honestly became friends. I mean, you know, they spent a lot of hours together in that car. Their kids and everybody, and they can't buy it. And they're not going to ever buy VA again. Now they'll be able to buy FHA in about 3 years, unless they can get that default cured. So if whatever the loss was, and I can't imagine a client doing that. So let's say if the VA ended up paying out $40,000 on the loss. If VA gets their 40 grand back, they can consider reissuing. Never seen it happen, but in theory it can happen. The last thing I'm going to share with you, then I'm going to open the floor for questions and answers, is anybody here other than Mr. Lamses aware of our test case short sale we're working on? So I think Michael's just trying to test me. I really do. He wants to see what I'm made of. So he brings me, he's out doing due diligence, he's knocking on doors, he finds a client, they want a short sale. So we start talking. And so we decide that, I find out a couple things. So I find out they're currently in a loan mod. So they've been in a loan mod now for about 2.5 years. Okay, that doesn't bother me too much. So I check the rules and I go into the guidelines that I showed you earlier and I look up loan mods, and we can do that if you want to look up rules. We can look those up right here. So I looked it up, and so as long as they've been current for the last 12 months on the loan modification, it is still eligible to refinance. And the short sale rule is on FHA, if you, it's either 3 years, or if you were not late on any item for the prior 12 months, anything, credit card, anything, then there is no supposedly waiting period to reapply for a FHA loan. So they do the online application, I run it, etc., and I see a boom, bankruptcy. So I go, short sale, mod, bankruptcy. I go in, and when the more I heard it, the more I'm going, really, Michael? Really? And then I sit down with the client, and they tell me what happened. So they bought this house. They got a pick-a-payment arm. Anybody not remember what that is? That's the negative. Pick-a-payment arm was the loans in 2002 to 2005, where you came in, it was 1%. The payment was broken down into 4 segments. You could pay 1% of the balance. That created 5% negative. You could pay interest only, that reduced no principal. You could do a 30-year payment, which was a payment they couldn't afford if they had to. And then there was a 15-year payment that they really couldn't afford if they had to. And those were called a pick-a-payment arm. And the big one for that was forever and ever was Washington Mutual. They started them, but they didn't have this bad a neg. And so what happened, what really hit us, so I'll tell you what really hit us in the debacle. In 2005, they hybrided. You know, they morphed. They kept taking these pick-a-payment arms and doing a little more and a little more and a little more. And at the end, they were paying the brokers. Even you guys are going to go. So I did a pick-a-payment arm. And if I put a 3-year prepayment time in, I could charge 1% origination on the front, and the lender would pay me 3% on the back.
Wow.
You think that got anybody's attention?
Oh, yeah.
Now, here's the problem. I don't even have a major problem, I do, but other than ethics, that they got paid 3% on the back. If you agree to it, fine. The part they don't tell is they didn't explain to the consumer what a picket payment arm did. And most of them had a 115% to 125% cap on the negative amortization. And it was happening in about 28 months before prices fell. So what that meant is, you bought this $700,000 house, the payment was based on 1%, okay, divided by 12, taxes and insurance. So yeah, you're moving along pretty good. And somewhere around the 25th month, you got a notice, you have now exceeded your negative amortization increase. So the balance started out at 400, but now it's 490. Or whatever the 125, 115. You now must, effective in 60 days, pay the full 30-year principal and interest payment, no longer interest only, and the 1% interest is no longer offered on your loan. And that's when the default started happening. My little lady that was a housekeeper, that's what got her. Her house payment went from $1,480 or $1,580 a month to $3,800 a month. Back to my customer. So they came in and they wanted to do a loan mod with City National Bank or something like that. Never heard of these people. And they said, well, your ratios are still too high. To get a loan mod, you cannot exceed 33%, or at that time you could not exceed 33% of the housing payment, and then it was 30, or maybe the whole payment. So I haven't done loan mods in a while. So they said, you've got to file bankruptcy because you got too much other debt. We won't entertain it. So they went and filed bankruptcy. Went through that 6-7 month process. And they came back and they got the loan mod. And they've never been late on the loan mod. So now their kids are moving out. He went out on disability and hurt his knee and his hip, and he was out for a while. And they have a 2-story house, and it's getting harder for him to go up and down. The kids are moving out, and now the mod is going up again for time 3. And they did this loan mod on a 4-step pick a rate or pick a payment. So they got 3% for a year, 4% for a year. It's going 5% in September, and it's going 6% next year. They can't afford it at 5, much less when it goes to 6. So they're going, what do we do? So after getting into it, what we're trying to do, and the first 3 or 4 weeks I was here, I was a little bored because I hadn't had any business coming in yet. So I said, I'm going to tackle this. Let's give it a go. Let's see if I can pull a rabbit out of my hat. And so I got into it, and I've asked them for a letter. Now these people, this is not their work. They're not finance kind of people. They don't understand a letter of explanation. I asked for a letter of explanation covering all this, and I got one little paragraph of maybe 15 lines covering what I just talked to you about in 10 minutes. That's going to be a 2-page letter of explanation. So I'm going to write it and have them sign it. They've been in 8 times, because I had the same list of documents I've asked for 5 weeks. And every time she shows up, she has 3 of them. And then next week I get 3 more. And then I get 3 more. She was in yesterday and I got, and it's always 3. I got 3. Now, I wanted the bankruptcy documents. I left them at home, and she's supposed to come in today and bring me those bankruptcy papers. And so when I have it all, I'm going to load it up, and if we can get it pre-approved, we don't want to list their house and sell it, thinking they're going to get approved. So we're actually going into underwriting. All their documents, a letter of explanation this long. We used to call it a cry letter. I'm going to put tears in that underwriter's eyes. Okay? These people have done everything they can think of. And so this has become my pet test. And every day Michael comes in and goes, what's going on Thoroughbred? And every day I go, well, she brought in 3 more. And Michael today goes, oh, we're 1 step closer. Now if we pull this off, that is very unique. So that means if I could pull off this one, that going down the road for you as agents, if you got somebody that needs a short sale, and they've been current on it for the last 12 months, okay, if I can get this one through, we can get others through that haven't got the other 17 hurdles that I jumped over, okay? And we get them pre-approved, they list their house, and they go buy a new house. Because they just have to have 3.5% down and da-da-da-da-da-da. So it could work out really something for all of us. It could be just the biggest, well, it's been very educational, and it has. And bless these people hard. They are trying so hard, but it's just not their thing. So, anything, I don't have anything else I could think of. What I was hoping to do is one of these a month. And the next one, this one was just dropped on me on Tuesday, by the way, folks. Lance said he wasn't going to be able to do it, would I take the floor? And so we decided a round table. So we haven't round table much. I've been trying to get some round table, we're not getting much. So, but I'm thinking about putting together a credit repair class in 1 month, and 4 or 5 weeks, and then you bring some customers too. What it takes to repair credit. What does repairing credit really mean? How much of it is kind of really pushing the envelope of ethical versus what's something you can really do? You know, I mean, we all know the old standby. If you send enough letters to a lender, the first time the lender doesn't respond in 15 days, they are required to drop it. You know, that's what most credit repairing agencies do. They rely on just, we're going to wear them down. And sooner or later, somebody makes a mistake and misses it, and they got one. Now, one account gave them 10 more points.
But can't they come back and put it back on
No.
after that? Oh, okay.
No,
Okay.
not anymore, not under the Fair Reporting Act. You're the professional, you were given proper notice, you didn't do your job. No. Don't agree with it, but it's the current rules.
Okay, I like it.
So, how about, anybody got a general question or a specific question, an underwriting scenario, something? I mean, put me on the spot, test me. Nothing? I thought for sure, Mike, you'd have something.
I got nothing.
You got nothing, I got nothing. So,
We're an easy crowd, so.
come on. You guys got it, you got a lot of experience, you got some, you gotta have one hidden back here. Let me throw this one at you. Nothing? Come on. All right, well, did you find today informative? It helped, or was it and don't hurt, you can't hurt my feelings. I'm old and I'm used to having my feelings hurt. Did you get any benefit out of this?
Mm-hmm.
Do you think having one a month, maybe one with a little more preparation next time will help you?
Yeah.
I think the credit reporting will be good. If you'll spread it with the other agents here and elsewhere, if you got things you want covered in the future, maybe you got specific products, or, you know, I know there are some people that like you doing USDA. I know there's others that are involved in, and I don't remember the number, it's another FHA program, it probably starts with a 2, but it has to do with the Indian program, if you're buying Indian reservation properties.
I have a question. I have a client that
I
has
know
one
you
where
Yes,
she,
They can.
they put so much in the, they put like 2,000 in the bank account,
yeah.
and they're getting 4,000 towards their down. Do you know what that program is? And how it works?
It's got to be a city program or a match for dollar program. There are a lot of down payment assistance programs. You know, the old one is CHDAP. Years ago it was Nehemiah and Hart. The problem I'm finding, especially now under sequester, you know, now we have the sequester funds, you know, when we went into taxes, more and more federal programs are being cut. So what I'm finding, that in this market, those down payment programs don't help you, because you got to do it with an FHA loan anyway. Almost every time it has to be with FHA, because
Right.
Fannie Freddie just doesn't really like them. Your offers aren't getting accepted, because you got to remember, if you have a down system, a payment program, they got to get approved by them too. They have criteria, just like that program we showed you a minute ago. They have all these crazy restrictions. So if we go back to, where is it here? That HUD program. Right here, it says program eligibility, property, but here was one, right? Annual certification. I saw one where they have income restrictions in here, and I'm trying to remember where I saw it. It might have been under here. Remember, I gotta remember all these links. But they do have income restrictions, and I'm trying to remember.
I know
what it is.
neighborhood stabilization program has it.
That must be the one. So, God, I just haven't done one of these in so long, but they were popular in certain areas. Come on.
Not only do they have income restrictions, if you are really broke but you had some money saved, then they
Yeah.
say you don't qualify.
Oh, here we go, annual certification. So we're just going to revisit, let's see what it says in here. I know I saw one that said, anyway, they have restrictions, and most of your down payment programs they have a minimum income and a maximum. I see quite often. So if you're two people, you can't earn more than 60,000 or something like that. But to get a seller in this market where we are short of inventory to go with 2 approvals, I think you would have pulled the proverbial rabbit out of your hat. You know, I mean, we're offering, I see offers at 20,000 above offer price and it's denied. I think the 2 best things that we talked about, for those who weren't in the sales meeting yesterday, was going back old school, presenting your offers in person. I think that's awesome. Just like I highly recommend you be there with the appraiser when the appraiser's done. I think those are 2 best practices in this unique time. That, you know, I mean, this is not only a buyer's market, this is a buyer, I mean, a seller's market. This is a seller, I own it. You do what I want or don't buy my house, because I got 13 more people or 35 more people over here that will buy it. So I haven't, in my, for those of you who don't know, I started doing this in 1974. Probably before you were born, right? So I have seen so many ups and downs in all that time. Nothing surprises me, but I have never seen a seller's market like this one. Even when they were buying, they were going up 200, 300,000, but not like this, because there was still tons of inventory. You know, the new homes. I mean, I remember when you used to have to, when KB Homes and Lewis and K. Hovnanian and all those and Lion, and they were going to have a release, and we would be there a day early, and I saw people 2 days early camped out in line because they were taking registration starting Monday morning at 8 o'clock for something they're not going to build for 9 months. Different market, different times, different people. First-time home buyer, that's less than. There is really no such thing as a first-time home buyer program at this time. FHA is your first-time home buyer program. What came out on that really triggered was in 2009 or 10 when they were given the tax refunds, state and federal. That was what was triggering first-time home buyer. And the definition was to find anybody who has not owned a home in the last 3 years. So if you owned a home 5 years ago, you were a first-time home buyer. I guess it's all. So here's the HUD pamphlets if you want them. I should cover it for today. I appreciate you guys coming in. I hope it was informative, and come see me anytime. And let me do your next cross call, folks. You know, let me protect your back and be there. You know, I think you'll like it.